Hello, I'm Jim Wilkinson, President of the Strategic CFO. We're going to discuss today what it means to break your debt covenants and what you should do about it.
How do you know you're getting ready to break your debt covenants? 1. Cash is getting tight. You're maxed out on your line of credit. Sales are declining. You're losing money. Your payables are getting stretched. Your vendors are calling. Your necessary purchases are being delayed, and your accountant is nervous. If one or more of these things are happening, you are in risk of breaking your loan covenants. So what is the purpose of loan covenants? They're basically a tripwire for the bank. Covenants give the bank leverage to force the company to either take corrective action or to liquidate the loan. Once you break the debt covenants, you are in default, and the bank can call your loan. You're probably saying, if I'm making my payments, why does the bank care about covenants? The answer is, as we'll discuss further, the regulators. What are the top 3 common mistakes companies make when faced with a debt covenant violation? The number 1 mistake most companies make is not communicating with their banker. The other 2 is not managing your compliance. And the other, finally, and not having a plan. Not communicating. Most companies turn in their compliance certificates and wait for the bank to call, all the while hoping that they don't. You should be talking to your banker as soon as you know you are having a problem. If possible, you should have a conversation before the certificate is due. Not managing your compliance. Often a company will run their business in a manner that ensures that they'll be out of compliance. For example, giving year-end bonuses that break the debt covenant ratio. You should be projecting out how your business decisions will affect your compliance. And finally, not having a plan. Companies will tell the banker that they have a problem, but will not offer any solutions. This action does not instill confidence on the banker's part. The company should have an action plan in that first meeting with their banker. So what happens when you become out of compliance? At first, the loan officer will meet with the company's management to discuss the cause of the covenant break. The loan is then put on a watch list that is reviewed by the loan committee weekly or monthly. And in some cases, it is sent to the workout group in the bank, or a workout officer is appointed to monitor the case. For the first 3 months, they just monitor the loan. It is during this period of purgatory that it is important that you keep the confidence of your banker in your ability to manage through the crisis. If at any time they lose confidence, then they may take harsher action. The bank has several options available to them, and none of them are good for you. Any one of these options can threaten the viability of your company. It is important to remember that if you don't make your payments, then all bets are off. Avoiding the problem is not an option. The first thing they can do is raise your interest rates. Since the risk associated with this loan has increased, the bank may take this opportunity to increase your interest rate. The rate can increase from 5-6% to 9 or 10% or more. In addition, they may charge a fee of 1 to 2% to forbear foreclosure action on the loan. Another option is to freeze the loan amount and not allow any additional advances under the line of credit. The company will then be forced to live off their operating cash flow. If receivables are not collected, then the company may find that they can't pay their bills. The next thing they can do is lower the advance ratio. Similar to freezing credit, the bank may choose to lower the percentage of collateral that they are willing to advance on. For example, instead of 80% of accounts receivable, they might only advance 70%. A more extreme tactic would be for the bank to call the loan. In this scenario, the bank would ask the company to find a new lender, or even worse, apply deposits against the outstanding balances as they are collected, in effect calling the loan. Finally, the bank may require additional capital in order to renew your line. You may be forced to give up equity to obtain that additional capital. One source may be mezzanine financing. Mezzanine financing is a blend between a bank loan and equity. It is basically a loan with an equity kicker. It is generally priced to yield in the low 20% range, well above the cost of traditional debt. In some extreme cases, you may have to sell out to a financially stronger competitor in order to protect your remaining equity. So what should your reaction be? It is far better to tell the bank before you break the covenants that you have a problem. Once that you acknowledge the problem, you must take corrective action. This is comprised of 4 things. First, you need to prove you are in control of your finances. Second, you need to have a plan. Third, you need to execute that plan. And finally, and most importantly, you need to communicate with your banker. Most companies assume that cutting costs will suffice. Cost cutting is just a stop along the way. If you don't have a plan, then you will end up at the mercy of your creditors. There should be 3 overriding goals of your plan. First, manage your cash. Second, get out of the current crisis that you're in. And finally, position your company to take advantage of the recovery. So what do we mean by control cash? First, don't bounce any checks. This brings more bad publicity at the bank. Second, don't call your bank on Thursday needing cash for Friday's payroll. It looks like you're not in control. With the advent of automated cash management reporting, companies have been relying on their banks to manage their cash. This is not the banker's job. Instead, you should project the needs of the company on a weekly basis using a daily cash report. Knowing your daily cash position as well as your weekly cash commitments will give you added impetus to collect money and to generate revenues. If the bank calls the loan or freezes your line of credit, then you will have to pay your bills out of the operating cash flow of the company. At this point, it becomes imperative that you monitor your accounts receivable collections. They are now your lifeblood. What happens if you don't collect your receivables? You could very well not make payroll on Friday. Just looking at accounting reports does not give you the complete picture, or in some cases, it's too much detail. You need to use a flash report or dashboard to actively monitor the keys to your success. You should develop a plan to get back in compliance with the covenants. A major component of this plan is the projection of cash needs. In addition to a projected income statement, you should also project the cash flow for the next 12 months. Finally, you should also project a balance sheet, and with that, calculated covenants. Your goal is to instill confidence on the bank's part that you can manage the company profitably going forward. The purpose of the dynamic cash flow projection is to enable you to see 6 to 12 months into the future. You should project out your debt covenants over the next 12 months. Show the bank when you will be back in compliance. The R-Series report is a detailed ratio analysis package that can be used to analyze and benchmark your company's financial health. Concurrently, they may also serve as a useful financial tool for interfacing with banks and other financial institutions. Incidentally, many banks will ultimately ask that the ratio analysis be done in order to gauge the financial health of the client, especially when compared to other companies in the same sector. Finally, you must show a willingness to take appropriate action rather than waiting for the next shoe to drop. You must give the banker confidence that you will execute the plan you have presented. Such actions might include collecting your bad accounts receivable, firing customers, cutting staff, giving up growth initiatives. By using these tools and strategies, you can successfully weather this financial storm.